All right, so geez, there's a lot going on around the world. So a fair bit to talk about. What we're going to discuss is a bit of an update on what's happening with COVID-19. Some significant developments, both positive and negative. Obviously, the positive being the vaccine developments, which I think are encouraging. I'll chat about that. Unfortunately, we've seen a significant escalation in infections in Europe and in the United States, and it's going to have a meaningful impact on their economies. Already it's starting to do that. And obviously, therefore, it can feed over into market performance, particularly equity market performance. We'll talk about how the US is doing. How are they getting their economy going? What have they done to stimulate? And you would have to say they've actually done exceptionally well so far, assuming they can manage the current surge in COVID-19 infections. It's not too bad. We'll also contrast that with China. China has got the infections well under control, it seems, and their economy also doing particularly well. So we'll talk about China, and then we'll look at South Africa, what's happening in our economy, how we're coping with it, where the pressure points, what is our government doing to try and lift growth, and what are our options. Clearly, the situation for South Africa extremely challenging. So hopefully all of that in around about 40 minutes. I'll be using, as usual, quite a few charts. As Ashley said, please, if you've got questions and you've got an option to type them up, please just type them up. We'll should have a few minutes after the presentation to deal with some of those questions. Also, if you want a copy of the presentation, we can email that to you. Or if you're looking for other information, please give us a shout. We can certainly try and source some of that. So as I said, there's good news and bad news around COVID and the spread of COVID. So let's start with, unfortunately, the bad news. And the bad news is that there are many countries in the world that are experiencing a second wave of infections. Most of those countries, I guess, are in Europe, not exclusively, but it's very evident within Europe. And what happened was that during April, May this year, there was obviously a flare-up of infections. And on the screen, I've got the number of infections each day in the UK. And you can see back in April, they were having around about 5,000 infections a day. And at that point, that seemed to justify an economic lockdown. And the UK went into a very substantial lockdown in April. And as a consequence, their economy deteriorated actually very sharply. So their economic performance in the second quarter of this year was worse than South Africa. Believe it or not, their economy was declining at about 60%. We declined by 51%. So a massive slowdown in UK economic activity. And then they seem to get the infections under control. They bring the infections down and they relax the restrictions. Unfortunately, in the UK, I think many people then assumed that this virus was behind them. In other words, they've dealt with the problem and they can kind of get on with their normal lives. And so the idea of wearing masks, social distancing, all of that was not adhered to actually in the UK. And the consequence of that is that in September, October, now November, the number of infections have ramped up very dramatically. Now, instead of 5,000 a day, you're sitting at well over 20,000 a day. And what that's done is force the UK back into a lockdown, fairly substantial lockdown. And there's no doubt that with this type of lockdown, the UK economy is going to have another negative GDP. And then obviously that occurs at exactly the wrong time, because you had the decline in the second quarter, you start to recover in the third quarter, it seems fine. And now you're probably going back into an economic decline. And that's actually happening across most of Europe. So if I showed you this chart for, let's say, France, it would be a similar pattern. If I showed you Italy, Spain, they've all had this massive second wave, and that has forced them into an economic lockdown. Not great, right? When we take the same numbers and we look at the US, we actually see a third wave. In other words, the US had initially a pickup, also around April, 30,000 a month. They seem to ease off a bit, although I don't think they ever got it under control. Then it escalated to 60 to 70,000 a day. They didn't bring that under control. And now it has surged to at least 140,000 a day on an average basis. Some days it's up at 180,000 in the US. The consequence of that is obviously more people in hospital. There's more evidence of hospitals being overwhelmed, even in the US. More people dying, obviously. And it's forcing parts of the US to introduce restrictions. Now, the US won't introduce a nationwide lockdown because in order to do that, you need the president to approve that. And President Trump is certainly not going to do that. But there are individual states or individual cities that are imposing restrictions. And because of those restrictions, we're starting to see that the US economy is losing a bit of momentum. So what this is doing is it's obviously heightened the need to start to manufacture and distribute the vaccines. And so this is creating a huge amount of pressure. Fortunately, the vaccine developments seem very encouraging. The news we've had so far relate to two particular companies that have made significant progress, although I need to stress that there are many companies around the world looking to develop an effective vaccine, and I think we're going to have many more announcements over the coming weeks, over the coming months. So please don't think that the announcements so far are the only options. There are going to be competing vaccines out there within a short period of time. So far we've had Pfizer, a drug company, make an announcement that was more than a week ago, saying that their vaccine is, they said, more than 90% effective. They pretty much now completing phase 3 trials of their vaccine. During the trial, they injected around 43,000, somewhere between 43,000 and 44,000 people. Half of those people actually got the genuine vaccine and the other half just got a placebo injection. I actually don't know what's in that injection. I'm not sure I really want to know, but it would be a non-vaccine injection and obviously an injection that has no effect. And then they simply measure how effective the vaccine appears to be. And as they say it's 90%. There aren't any particular side effects that are significant. There are side effects, but the side effects appear to be manageable at this stage. So no real concerns from that perspective. But there are many questions we don't know. For example, how long does the injection last? You've got to take 2 injections. It's not as if you just have 1 injection and then it's done. You've got to actually have 2 injections, and then it takes 28 days for the vaccine to become effective. You're not immune immediately. So after 28 days, it's then fully functional, if you like. But how long does it last after that? We don't know. How many follow-up injections might you need? We don't know. But it seems certainly very encouraging. And Pfizer says they will manufacture 50 million doses by the end of this year. And then they are claiming they'll manufacture 1.3 billion doses during the course of next year. And obviously then it's a process of distributing that as broadly as possible and starting to put the world in better shape. Linked to that, a company in the US called Moderna, which is a company you probably never heard of because it's a specialized pharmaceutical company. And they've also released update on their vaccine, somewhere between 94 and 95% effective. They tested 30,000 people and a similar process. So these companies will now apply for regulatory approval next week. And we think the regulatory approval will be done quite quickly. And then they'll start to try and distribute that vaccine. The vaccine will initially be distributed to healthcare workers and to people typically over the age of 65, and other people who are seen as vulnerable from a health perspective. And then obviously you're going to try and ramp that up. But remember, there are many other companies, and we'll see more vaccine announcements. So hopefully during the course of next year, it becomes evident that a viable vaccine is gaining traction in terms of distribution. And that will obviously help to ease concerns, right? But we've got to be realistic. When will that actually be rolled out comprehensively around the world? And you would say that's going to take many months, possibly a year or more. So for a country like South Africa, it's still going to be a considerable time before we see a vaccine being distributed in South Africa. We haven't signed up for the Pfizer vaccine. We haven't signed up for the Moderna vaccine. So we're going to, I think, have some time to go before a vaccine is available within South Africa. In the meantime, these countries have to manage the infections, and so does South Africa. Now, one country that's done well in terms of managing the infection is China, right? So if you go back to the start of the year, they were having around 4,000 new infections a day. They were the guys that caused this damn problem, but then they got over it. They had the lockdown, and subsequent to that, if you look at the data, no resurgence, no pickup, no second wave. They do have new infections, about 20 a day, but 20 a day is nothing when you consider the size of the population. And so on the face of it, China is coping well. China themselves have developed they've got two companies developing vaccine, government agencies developing vaccines. And I think China has started to distribute their vaccines, but within China. I spoke to somebody who said that in China, you can buy it for $65. You can buy the vaccine. I haven't been able to verify that. But I think China will focus their vaccine distribution internally. So China seems to be coping with this very well, and their economic data looks good. The US and Europe, they're going to have to deal with this second and third wave. And I think that's going to have some impact on the economic performance. And therefore, we've got to be very mindful of that when it comes to our investment performance. And Rico will talk about some of that in more detail. For South Africa, our infection numbers seem okay. We're looking at an average of just short of 2,000 on a daily basis over the past week, although I need to stress that there have been a couple of days now where our number of infections have gone up to 2,000 a day. So therefore, there is a risk here that this thing starts to generate another second wave. And that's what South Africa's got to be vigilant about. Imagine going now into another severe lockdown. That would cause huge difficulty amongst many companies in South Africa, more unemployment. The government doesn't have money to fund that. So it would be especially problematic for South Africa. The risk for us is not so much now, but when we get to winter months. So next winter, that's when the concern is that we could have a second wave, because naturally this thing gains traction during the colder months. So we've got to be vigilant over the coming months, and then hope we can make some traction in securing a vaccine for ourselves, so that if we do start to see a second wave, then at least we got the safety net of a vaccine that's been systematically distributed in the background. So a testing time, I would say, for South Africa, but at least it's not overwhelming our healthcare system at this stage. So hopefully that gives you some idea of where the focal point is in terms of the virus. Let's have a look at how economies are coping. Let's start with the US. So if you look at the US performance, obviously a substantial decline in the second quarter of the year. Their economy declined by around 30%. Remember, South Africa went down 51%, the UK 60%. So these numbers are enormous. The US, for the US, given the size of their economy, a decline of 30%, very dramatic. But then if you look at the chart, in the third quarter, they have a resurgence of 33%. And so when you look at a range of economic data out of the US, they are in a strong recovery phase. which means that they've got to try and manage this virus. Otherwise, that recovery phase will peter out completely. But as it stands, the data still looks reasonably good. Now, to me, the interesting part of this is how the hell did the US get this right? How did the US go from 30% decline to 33% increase? What did they do? And what they did in simple terms is they paid people to go shopping. Bizarre, hey? They paid people to go shopping. We know that the US is very good at shopping. We know that they can turn on shopping very quickly. And that's what they did. They played to their strengths. They essentially paid people to do shopping. Now, what's happened to, first, let's understand what's happened to US employment and what role that has played. And then we'll look at how they paid people to go shopping. So when you look at US employment, it was doing exceptionally well. They were sitting at about 153 million people employed, all-time record high, unemployment rate 3.5%, and then the lockdown, the virus hit. And once the virus hit, they lost more than 20 million jobs. And what that did was it wiped out all of the employment gain over the last 10 years. Phenomenal loss of employment during the lockdown, right? And as they ease that lockdown, so they're starting to add jobs back. But if you look at the chart, they're nowhere near where they were. That's still some way off. In fact, they're just over 10 million people less employed now than they were before COVID-19. That's a lot of people that still have to try and get their jobs back just to go back to where you were. Yet, they've been able to stimulate a massive surge in economic activity. So what the US government did was they said, we are going to increase unemployment insurance. If you become unemployed, we're going to pay you more money, a lot more money. So typically, let's say that you lose your job in the US. You are entitled to unemployment insurance. And the amount of money you're entitled to varies from state to state, depending on where you live, but around $300 a week. So let's say you lose your job, the government now pays you $300 a week, and you can do whatever you want with that $300, right? That $300 doesn't last forever. It lasts for a certain number of weeks, and then the government assumes that in that time, you would have found another job. So at some point, that unemployment insurance will end. What the US government did was they said, okay, so if you're unemployed, you get your $300, but in addition, we're going to top that up with $600 a week. So now you're finding that you're receiving $900 a week, right? Do the maths, look at the exchange rate. How much would that be in South African terms? That's significant. And it turns out that in the US, receiving that extra $600 meant a lot of people were earning more money being unemployed than actually having a job. So what did the people do with that money, that extra money that the government paid them? They took that money and they went shopping. And because they went shopping, US retail sales has gone to an all-time record high. Phenomenal. Even though your employment is 10 million people below the record level, retail shopping is at a record level, paid for by the government. Beautiful, right? So let me show you how much money the government has spent on unemployment insurance in the US. And this is monthly data. And it includes the global financial market crisis, 2009. Can you see how much money the government was paying in 2009, 2010 on unemployment insurance? It was significant at the time. Look at it relative to the surge during the course of this year, where instead of paying 100 to 200 billion a month, you're now at well over $1 trillion a month. That was the surge in the unemployment insurance. Massive increase. And so what households did was they got this money from government and they simply went shopping. And so when you look at shopping in the US, it goes down. Yes, in April, it goes down because That's the lockdown. That's the worst of the lockdown. Businesses are closed. People have lost their jobs. A disaster. But then look at how quickly retail sales recovers and is now at a record high, paid for by government unemployment insurance. Alongside of this, there are other dynamics that obviously change, right? And one of the most important dynamics is that not all of the shopping that you're seeing here is being done in physical stores. There's been an extra surge in online shopping around the world. And we've got to be aware of that from a property perspective, right? A lot of us are invested in property, and we've got to understand that the dynamics around property is changing. That as people move more online, they don't need as much physical store. And so shopping centers and retail centers are all under pressure and having to restructure their portfolios. And we're in the midst of that. No matter where you are in the world, it's a factor. But we've also got to realize that there are other areas of property that then become in high demand. So think about warehouse space. If you're going to be selling something online, suddenly you need space to store stuff. You need more warehouse space. And so we find that the demand for some of the industrial space, that's gone up. Some of the space to distribution hubs, gone up. So from a property portfolio perspective, yes, there are a lot of concerns, but it's about reorganizing your investment so that you take advantage of where there is some demand and try and mitigate where the demand has fallen. So under current circumstances, less demand for retail, less demand for outright office space, but more demand for convenience shopping. We've seen the surge in demand for shops very close to people's homes, where you can just go out quickly, get something, come back. That's gained in acceptance. More demand for industrial distribution. So it's about reorganizing that investment portfolio. And if you look at US online shopping, I just want to show you the surge. This is the percentage of US retail sales done online. And you can see that steady increase. So this is not a new trend. This is a trend that has been evolving for some time. But look at the surge in the latest number. It's because suddenly, because of COVID-19, much more is being done online. And it looks likely that a lot of that will end up being sustained. So we've got to adjust for that in our investment profile. Please be aware of that. Rico will talk about property a little bit more, but it's about reorganizing the investment and looking for the opportunities in a new economic context. All right, so the US government pays people to go shopping. What does that mean? Where does the US government get the money from? Well, it's simple, they borrow the money. So look at the US federal budget. The number surges, expenditure ramps up very dramatically, tax revenue goes flat, which means the US government becomes a hell of a lot more indebted, massively. How does the US government get to afford that? Well, they've got a special advantage. What is their special advantage? The US Federal Reserve is printing money, called quantitative easing. And what the US Federal Reserve did was it said, okay, we've got to fund the US government. We'll increase the purchases of US government bonds on an open-ended basis, no restriction. And so the US Federal Reserve has printed a huge amount of money, and since COVID started, they've bought $2 trillion more of US government bonds. And how did the Federal Reserve pay for that? They printed it. Beautiful, right? So in simple terms, it means the Federal Reserve prints money. They take that money, they buy US government bonds. The US government takes that money and distributes it to unemployed people. Unemployed people take that money and go shopping. And as a result, the economy recovers. So why don't other countries around the world do the same thing? It would be brilliant. In South Africa, our Reserve Bank simply prints money, and we use that money to pay SAA, to pay Eskom, to pay unemployment insurance. The problem, the difference is that the US has the dollar and we have the rand. And it turns out that in the US, even when you print this amount of money, trillions more, people still love the dollar. So the dollar hasn't weakened dramatically, a bit of weakening, but nothing significant. And as a consequence, inflation in the US, well under control, well below their target of 2%. So no inflation consequence, no currency consequence, and so the US is getting away with it. They can continue to do that, and they will. They will just keep adding this liquidity. If South Africa tried this, what we think will happen is that the rand will weaken dramatically because people don't love the rand the way they love the dollar. The rand would weaken, which means we would then have a massive surge in imported inflation, which means we will start to do a huge amount of damage to people's incomes. And at the same time, the Reserve Bank would probably feel compelled to raise interest rates. So it's not an option. It's not a viable option for a country like South Africa. And it's one of the strengths that the United States has that they're now utilizing for their benefit. Good if you can do it. Eh? Okay, let's quickly look at China. I won't spend as much time on China, how they're doing. Their economy went down in the first quarter, recovered strongly in the second quarter, continued to grow in the third quarter. So they've also manufactured this brilliant turnaround. How did China do it? Well, they didn't go shopping. Yes, they shop, obviously, but that's not how they got the recovery. How did China get their recovery? China did what they're good at. What is China good at? Building stuff. And so China simply turned on the infrastructure tap. It said, we're going to build more infrastructure. The government's going to finance it. We're going to deliver this through state-owned enterprises, through local state government. And we are going to fund this at a central level. And that's what they did. And because they're very good at infrastructure development, they were able to do this very quickly. And the effect is enormous. So look at what's happened to manufacturing in China, industrial production. It goes down in February. They have their lockdown. It's a bit weak in March, but then by the time you get to April, the infrastructure is started. And the infrastructure's continued on, and the latest number in Chinese industrial production, plus 6.9%. In volume terms, phenomenal. That means industrial production is actually now slightly above where they've been in recent years. In total, industrial production in China has gone to an all-time record high. And so what they're now looking for is that this benefit, this improvement in manufacturing now rolls out into other parts of the economy. Is that happening? Yes. Let me show you retail sales. So what happens with retail is it's doing okay. You have the lockdown and retail comes under enormous pressure. And then it stays under pressure because this is not the portion that you are stimulating. You're stimulating the production side of your economy. But eventually, more people employed, the benefit from manufacturing spills over into retail, and now we see that retail is growing year on year. Not back to where they were, but clearly the trend is on the right direction, and it's entirely feasible that within 6 months, they'll be back to the growth rate in retail they experienced before COVID-19. And so China, the world's second biggest economy, is in a solid economic recovery. And at this stage, we are forecasting that next year they'll grow their economy by about 7 to 8% above their long-term average. All because they quickly stimulated that part of the economy that they are good at. So let's have a look at South Africa with that in mind. What are we doing? The problem for South Africa is that our choices as to how we respond limited. It's not clear that we have a distinct part of our economy that we're really good at, that we could suddenly make happen overnight effectively. So we don't have the same choices. From our perspective, our economy, we think, will decline by around 8% this year. That's dramatic, right? We had a decline of 51% in the second quarter. But importantly, we're going to have a positive third quarter. We're still waiting for the data, but the recovery in a number of sectors in South Africa has actually surprised on the upside. So please be aware that when you see the next GDP, it's going to be very high. At the moment, I'm working with plus 35%, but I'm going to revise that up. The data has been coming out better than expected. So we are in a recovery phase, but even with that recovery phase, we still think we're going to have a significant decline for the year as a whole. Next year, I've got growth of 3%, and many people say to me, well, where do you think 3% is going to come from? 3% is off a low base. So please look at the 3% relative to declining by 8%. If you go down by 8% and then grow by 3%, you're nowhere near where you were before you started. So look at the 3% as a base effect. The question for South Africa is, can we achieve 3% sustainably? That's the focus. So let me show you how our key sectors are performing, and you can see, I'm going to hope you can see the recovery. So look at mining. There are two things to point out. One is before COVID-19, can you see that mining production? Yes, it's volatile every month, but it's kind of just flatlining. Mining production was not vibrant. Then we have the lockdown in April, and mining production falls sharply. But look at the recovery after that. That's impressive. And that's got a lot to do with precious metals. It's got a lot to do with gold. It's got a lot to do with platinum. And it turns out that the price of platinum and gold is doing well, and we've been able to benefit, and we are exporting that. So parts of the mining industry have had a encouraging number of months. Obviously, in total, production's not back to where it was. We've still got some work to do, but at least we've made significant progress. Look at manufacturing, you'll see the same trend. So manufacturing, flatlining before COVID-19, not growing. We know this economy was stagnant. It goes down during April, that's the lockdown, and then it recovers quite strongly. Actually, it recovers more than most people expected. Yes, manufacturing's not back to where it was, but at least it's made progress. So when we look at our economy, we are in a recovery phase. We are bouncing back, if you like. Look at retail sales. Retail sales has a slight incline. So it turns out that we're fairly good at shopping, or we're better at shopping than we are at manufacturing. So retail sales has a slight incline. It goes down sharply in April, but now it's recovering. Again, it's not back to where it was, but at least it's bouncing back. So all of that is reasonably encouraging, but it's not enough, because we're only going back, therefore, to where we were before COVID hit. And before COVID hit, this economy was in dreadful shape. So the question for South Africa is, can we do better? Can we lift the growth rate meaningfully above that? And if we can, the markets will respond. There's value in South African equities if we can get the economic growth. That's a massive focus for us. So what are we doing to get the growth? Now, the first thing we did was we cut interest rates. And this year we've cut rates 300 basis points, and the Reserve Bank meets tomorrow. And there's a chance they'll cut another 25 basis points, and that would be very welcome. So the Reserve Bank has been cutting rates, right? Now, how does that help us? Well, it does help us, but it helps us to a limited extent. The main way that it helps us is that it relieves the pressure on people who've got debt. So let's say you've got a mortgage. You'll find that the cost of your mortgage is lower. That's definitely a benefit. You've got more discretionary spending. You can take that money and you can go and do some other shopping. But what it's not doing is it's not enticing people to go and buy a new house, a new car. So we're finding that credit is subdued. people haven't got the confidence to take on a huge amount of credit. And banks, quite frankly, don't have the appetite to grant credit. So the benefit of a lower interest rate is limited. There is a benefit. I'm not saying don't cut interest rates. Cutting interest rates is critical. But we've got to be clear about what interest rates can do, and the benefit is limited. So let me show you the growth in our mortgage credit in this country. So this is just residential mortgages, home loans. You can see it was on a slight incline before COVID-19. And then when COVID hit, what happened to the granting of credit? It slowed dramatically, and it remains lowish. And that is despite us cutting interest rates 300 basis points. The reason is people don't have the appetite, the confidence to go out there and buy a house because you don't know about your job. You don't know what the economic environment feels like. And so you're holding or adopting a wait and see approach. So therefore, interest rates are not the solution. They help, but they're not the solution. So that means the focus then switches to government. What can government do to stimulate the economy? The problem for government is they've run out of money. And the good news, I think, is that government now knows that. Certainly the Minister of Finance now knows that. And he made that abundantly clear this year. He did what's called a supplementary budget in June, and then he did the medium-term budget in October. And in both those statements, he made it abundantly clear that the government has a money problem. So let me show you the money problem and therefore the restriction. Look at the bottom line, the light purple line to start with. That is government tax revenue. And that number is okay-ish. This year, yes, it goes down. If you look at the chart 2021, into 21, the number goes down. And obviously, we're collecting a lot less tax revenue this year because of the economic slump. But when you stand back and look at the chart generally, tax revenue around 25% of GDP. But not accelerating, not going up dramatically. So it's steady, but it depends on GDP. In other words, if government wants a lot more tax revenue, what do they have to do? Increase GDP. People say, oh, government is going to increase the taxes because they're desperate for money, so they're going to increase taxes to collect more money. National Treasury is telling us no. Why? Because their own studies tell them that if they increase taxes, they'll probably do more harm than good. It'll become counterproductive. In other words, if you increase the VAT rate, the corporate tax rate, the individual tax rate, you're going to hurt the economy. Therefore, you might well collect less tax revenue. That's what National Treasury is telling us. That's not our research, right? National Treasury told us that, which means they're not looking to increase taxes dramatically over the next couple of years. In the budget, they've put in 40 billion more tax revenue over the next 3 years. That's small, that's minor. That's not a significant tax hike. So the government's problem is the top line, the dark purple line. That number is going up as a percentage of GDP, and this year will go even higher, record high, which means government has been spending at a crazy pace. So the minister is saying is that he's got to bring this down. And if he doesn't bring the government expenditure down, South Africa is going to have an outright fiscal crisis. So how does the government plan on reducing expenditure? Well, here's what they've got to look at. I'm going to skip over a chart. I'm going to come back to it. What the government is saying is that they've got to control that part of the budget they're able to control. So I've just put two numbers on this chart. The first number is the increase in debt service cost, the interest cost of their debt. And government is telling us that over the next 3 years, the interest cost of debt is going to rise by 16.1% a year. That's phenomenal, which means there's huge pressure because of the amount of debt government has. The interest bill is becoming exorbitant. So in order to control the overall budget, what is government saying they've got to do? They've got to control the second number on the chart, what's called compensation of employees. What is that? Salaries. So the Minister of Finance is saying that they cannot increase salaries for the next 3 years. They negotiate the next multi-year wage agreement in the first half of next year, which means the challenge for government next year is to sit with the trade unions and convince them that they must accept a zero increase in salaries for the next 3 years. That's what the budget is. Now, here's the scary number. I find this number truly scary. Let's assume that government can control salaries for the next 3 years. Let's assume they get that right. Zero increase for the next 3 years. What does government debt look like if they control salaries? Turns out government debt is going to 95% of GDP. So when you go to government and you say to government, hold on, you must spend more money to get the economy going. Tito says, have you seen where the debt is already going? Have you seen where the interest cost is already going? If I spend more money, I'm going to bankrupt the government. I'm going to have an outright fiscal crisis. I can't do it. He's right. The government can't afford the stimulus because already government debt is going to 95% of GDP. Now, let's say that government salaries go up by 4.5%, not 0%. What's going to happen to this chart? What's going to happen is government debt is going to go over 100% of GDP. And we're going to quickly rush to the point where government can't afford to make their payments, which means there's a risk that if government doesn't become disciplined, government is heading to a default, an outright fiscal crisis. And that's what the Minister of Finance is warning us about. And he's right. Government has misbehaved during the good times, which means when the bad times roll around, there's nothing left in the kitty to use. That's our problem. And Tito's trying to make that clear to government. And I think slowly government has to listen. There's evidence of some parts of government listening. So we still need the growth. Government can't provide the stimulus. The interest rates have a limited effect. What's the solution? Fortunately, thank goodness, government has finally come around to the solution. There is only one solution. What is that solution? Private-public partnerships. So government is now saying that they want to drive infrastructure. They want to drive infrastructure development into critical areas where we've got a lack of infrastructure. There's no doubt South Africa's neglected the infrastructure. Let me show you quickly our infrastructure spend. That would normally be done by state-owned enterprises. And have a look at this chart in the last 10 years. No growth in infrastructure spending. That's because the state-owned enterprises are essentially now bankrupt. And they actually have been bankrupt for some time. Yes, we developed infrastructure back before the Soccer World Cup, but since the Soccer World Cup, no infrastructure. That doesn't mean we haven't spent the money. Of course, we spent the money. We just didn't spend it on infrastructure. So government is now saying, hold on, we still need the infrastructure, but we can't rely on state-owned enterprises to deliver. So how are we going to do this? Well, they've decided to create an infrastructure fund. That fund sits within the Office of the Presidency. That fund is already being created, and it will be governed by a guy called Dr. Ramaphosa. So if you are invited to a presentation to listen to Dr. Ramaphosa, I urge you, please attend. He comes across well. I think he's on top of this. I think he means well, and hopefully he can gain traction. So government starts this infrastructure fund. The fund is going to be ultimately administered by the Development Bank. The Development Bank is busy recruiting people from the private sector to get involved in helping this. On top of that, government has now identified a range of infrastructure projects which they say can go ahead very quickly. These are projects which have been developed in the past but were never built. Road projects never built, water projects never built, housing projects never built. So government is saying we've got these projects, they're ready, we can start to build them fairly quickly. So where the hell do we get the money from, right? And that's the crux. And it turns out that government now recognizes that in order to do this, they have to partner with the private sector. And so government is saying, let's do infrastructure using PPPs, private-public partnerships. Now, is the private sector interested in this initiative? Turns out, yes. Why is private sector interested? Because the investment offers a good return relative to alternatives. And so private sector is saying, yes, we're interested, but we need a lot more information. What do we need to know? We need to know which projects. We need to know who's doing the projects. We need to know the tender process. We need a lot more information because we need to know these projects are going to get done. There's not going to be corruption, and they will ultimately be successful. And so that dialogue between private sector and government is currently underway. I'm aware of some of that. In other words, I've been involved in some of that. And what I can tell you is that it's making good progress. And so it's become the most encouraging aspect to the South African economic turnaround. It's still got some way to go. And I think part of it will be changing Regulation 28 of the Pension Fund Act. Now, let me just finish with that. Regulation 28 creates a whole lot of scare because there's a risk. There's a risk that you introduce prescribed assets through a change of Regulation 28. That's not the intention. The Minister of Finance has made it very clear to us that what he wants to do is to change Regulation 28, which allows pension funds to invest in infrastructure on a voluntary basis, not on a prescriptive basis. In other words, he categorically stated that it's up to the pension fund. If they want to invest, they will be allowed to invest. If they don't want to invest, that's their choice. So I think there will be some changes. I think there will be a carry-on of this initiative. And right now, it's pretty much the main positive focus in South Africa. And I think if we can get some of these projects going, it will start to provide that confidence and uplift, which hopefully then we can build on. In the meantime, we've got to keep our virus numbers under control. We've got to monitor what's happening with the vaccine. I think this arrest of various people with regards to corruption is a positive, and I think it will gain a bit more momentum. So I think I've become a bit more encouraged in the last couple of weeks than I have been in recent months. And that is despite the COVID-19. So I think there are a couple of areas to focus on. And hopefully next time we chat, I can give you a bit more positive information about some of these developments. That's all from me. I think I've gone over time. I apologize for that. Ashley, are there any questions?